Mark Zuckerberg has sold over $11 billion worth of Meta stock while simultaneously promoting the most aggressive artificial intelligence narrative in the company's history. This isn't coincidental timing or routine portfolio management. This represents a pattern that financial historians recognize as one of the most reliable warning signals before major corporate collapses and market corrections. When executives aggressively promote revolutionary business transformations while systematically liquidating their personal holdings, it creates a disconnect that has preceded some of the most devastating corporate failures in modern financial history. Understanding this pattern requires examining how insider selling actually functions as an early warning system for investors who know how to recognize the signals. Corporate executives possess information about their businesses that outside investors cannot access through public filings, earnings calls, or analyst reports. They understand competitive pressures, technological limitations, regulatory risks, and operational challenges months or years before these issues appear in financial statements or analyst coverage. This privileged access creates information asymmetries that sophisticated executives exploit through strategic timing of personal stock transactions. Internal board meetings reveal competitive threats that won't become public for quarters. Development teams report technical failures that marketing departments won't acknowledge publicly. Financial planning sessions identify revenue shortfalls before external guidance adjustments. When executives begin systematic stock sales while maintaining public optimism about business prospects, it suggests they privately recognize problems that haven't yet become apparent to outside investors. The timing of these sales relative to public statements creates what analysts call narrative reality divergence, where promotional messaging contradicts the revealed preferences demonstrated through personal financial decisions. Meta's situation exhibits classic characteristics of this narrative reality divergence. Zuckerberg has accelerated stock sales to unprecedented levels while simultaneously positioning artificial intelligence as the transformative technology that will revolutionize Meta's business model and justify current valuations. The company has committed over $15 billion annually to artificial intelligence and metaverse development while generating minimal revenue from these investments. Securities filings show Zuckerberg's sales increased 70% during quarters with maximum AI promotional activity. His trading plans executed during earnings calls, where AI capabilities received primary emphasis. Personal wealth diversification accelerated precisely when public AI commitments reached historical peaks. The mathematical impossibility of Zuckerberg's AI promises becomes apparent when examining actual revenue contribution from artificial intelligence initiatives relative to development costs. Meta's Reality Labs division, which encompasses both metaverse and AI development, has generated cumulative losses exceeding $30 billion while producing revenues that represent less than 3% of total company income. Yet Zuckerberg continues promoting AI capabilities that would require fundamental breakthroughs in technology that don't currently exist. The division's quarterly loss rates exceed $1 billion consistently. Employee headcount in AI research has tripled without corresponding revenue increases. Patent filings in AI have surged while commercial applications remain virtually non-existent. This disconnect between promotional narratives and financial reality follows a predictable four-stage pattern that has appeared before major corporate collapses throughout modern business history. Stage 1 involves executives promoting revolutionary technologies or business models that promise to transform company prospects. Stage 2 includes massive capital allocation toward these initiatives despite limited revenue generation. Stage 3 features accelerated insider selling, while public promotion intensifies. Stage 4 culminates in reality recognition when promised transformations fail to materialize, and investors realize the disconnect between narrative and fundamentals. Cisco Systems during the late 1990s provides the most relevant historical parallel to Meta's current situation. Cisco executives promoted internet infrastructure as revolutionary technology that would transform global commerce, while the company traded at valuations exceeding 100 times earnings. CEO John Chambers became the face of internet transformation, appearing on magazine covers and conference stages promoting networking technology as the foundation of new economic paradigms. Chambers predicted internet traffic would double every 100 days indefinitely. Company presentations projected exponential growth in data center requirements. Marketing materials promoted internet protocols as revolutionary as electricity or telephone systems. However, Securities and Exchange Commission filings revealed systematic insider selling by Cisco executives throughout 1999 and early 2000, while public promotion reached peak intensity. Chambers and other senior executives liquidated hundreds of millions in stock while telling investors that internet growth would continue indefinitely. The company invested billions in research and development while acquiring smaller companies at premium valuations to maintain growth narratives. Form 4 filings documented executive sales totaling over $2 billion during peak promotion periods. Board members eliminated personal holdings while recommending stock purchases to employees. Stock option exercises accelerated during quarters with maximum bullish guidance. When the internet bubble collapsed in 2000, Cisco stock declined over 90% as investors recognized that networking infrastructure demand couldn't support the valuations that speculative optimism had created. The company's business model remained viable, but investor expectations based on promotional narratives proved completely unrealistic. Executives who had sold stock during the promotional phase avoided catastrophic losses, while retail investors who believed the transformation narrative lost substantial wealth. Enron represents the most extreme example of narrative-reality divergence, where executives promoted energy trading and complex financial instruments as revolutionary business innovations, while the company's fundamental operations remained dependent on traditional utility businesses. CEO Jeffrey Skilling and other executives sold hundreds of millions in stock while promoting Enron as a technology company that had transcended traditional energy sector limitations. Skilling personally liquidated over $60 million during peak promotional periods. Executive presentations promoted trading algorithms as proprietary technology, creating sustainable competitive advantages. Company materials described energy derivatives as financial innovations comparable to modern banking systems. Enron's promotional narrative involved sophisticated financial engineering and energy trading platforms that supposedly generated consistent profits regardless of commodity price fluctuations. The company positioned itself as the Amazon of energy, utilizing technology and financial innovation to create competitive advantages that traditional utilities couldn't match. Analysts and media coverage embraced these narratives, with Enron receiving recognition as America's most innovative company for 6 consecutive years. However, subsequent investigations revealed that Enron's innovative business model consisted primarily of accounting manipulation and off-balance sheet financing that concealed massive debts while inflating reported revenues. The technology and trading capabilities that executives promoted publicly couldn't generate the profits necessary to support the company's valuation or service its hidden debt obligations. When reality emerged, Enron collapsed completely, destroying shareholder value and employee retirement accounts, while executives who had sold stock early avoided personal losses. Theranos provides the most recent example of narrative-reality divergence, where CEO Elizabeth Holmes promoted revolutionary blood testing technology, while the company's actual capabilities remained far below promotional claims. Holmes became a media celebrity promoting fingerstick blood testing that would supposedly replace traditional laboratory methods while raising billions from investors based on technological capabilities that didn't exist. Holmes appeared at major conferences claiming breakthrough innovations in medical diagnostics. Company presentations showed proprietary devices supposedly performing hundreds of tests simultaneously. Marketing materials promoted partnerships with major retailers that would revolutionize healthcare delivery. The Theranos narrative involved proprietary devices and analytical methods that could perform hundreds of medical tests using tiny blood samples, representing breakthrough innovation that would transform healthcare while reducing costs dramatically. Holmes appeared on magazine covers and conference stages promoting this vision, while the company's valuation reached $9 billion, based primarily on promised technological capabilities rather than actual revenue or demonstrated performance. Investigation by journalists and regulatory authorities eventually revealed that Theranos devices couldn't perform the tests that Holmes promoted publicly, with the company using traditional machines for most analyses while diluting samples in ways that compromised accuracy. Holmes had been selling stock and raising capital based on technological claims that internal documents showed she knew were false. The company collapsed completely when reality became public, destroying investor wealth while Holmes faced criminal prosecution for fraud. Meta's artificial intelligence narrative shows concerning similarities to these historical examples. Zuckerberg promotes AI capabilities including advanced language models, computer vision, and autonomous systems that would revolutionize social media, advertising, and human-computer interaction. The company has committed massive resources to AI development while generating minimal revenue from these initiatives and facing increasing skepticism about the practical applications of current AI technology. Meta's AI research papers describe theoretical capabilities that remain unproven in commercial applications. Company demonstrations showcase controlled environments that don't reflect real-world deployment challenges. Technical presentations discuss AI breakthroughs that competitors have achieved more efficiently with fewer resources. The timing of Zuckerberg's stock sales relative to AI promotional intensity creates the same narrative reality divergence pattern observed in previous corporate collapses. As AI promotion has intensified, Zuckerberg's stock liquidation has accelerated, suggesting private recognition that AI transformation narratives may not justify current valuations or development costs. His selling represents over 40% of his total Meta holdings during the period of maximum AI promotional activity. Trading plan modifications occurred immediately before major AI announcements. Personal wealth diversification accelerated during earnings calls emphasizing AI capabilities. Stock dispositions increased during conferences where Zuckerberg promoted AI transformation most aggressively. Meta's fundamental business model remains dependent on advertising revenue from social media platforms that face increasing regulatory pressure, user engagement challenges, and competition from newer platforms like TikTok. The company's core Facebook and Instagram properties show declining user engagement among younger demographics, while attracting scrutiny from governments worldwide regarding privacy practices and social impact. European regulators have imposed billions in fines for privacy violations. Congressional hearings repeatedly question Meta's business practices and social impact. Advertiser boycotts have created revenue volatility unrelated to AI development progress. Artificial intelligence initiatives cannot address these fundamental challenges because AI technology doesn't solve the underlying problems of social media platform sustainability, regulatory pressure, or competitive threats. Advanced AI capabilities might improve content recommendation algorithms or advertising targeting efficiency, but they cannot create the revolutionary transformation that would justify $15 billion annual development costs or support premium valuations. The revenue mathematics of Meta's AI investment become particularly problematic when examined relative to total addressable market constraints. Global digital advertising markets, which represent Meta's primary revenue source, cannot grow fast enough to justify the returns necessary for massive AI development costs. Even if AI technology improved advertising effectiveness significantly, market size limitations constrain the revenue potential relative to development investments. Meta's metaverse initiatives, which overlap significantly with AI development efforts, have demonstrated the gap between promotional narratives and commercial reality. Despite billions in development costs and aggressive promotion by Zuckerberg, metaverse adoption remains minimal among both consumers and businesses. Virtual reality and augmented reality technologies continue facing fundamental limitations that massive capital investment hasn't resolved. Consumer VR headset adoption rates remain below optimistic projections by substantial margins. Enterprise metaverse applications have generated minimal revenue despite years of development investment. User engagement in virtual environments peaks briefly after launch before declining to unsustainable levels. The psychological aspects of narrative reality divergence affect investor decision-making in ways that benefit insiders who recognize the pattern while harming retail investors who believe promotional messaging. Executives understand that revolutionary narratives create investor excitement that supports elevated valuations, even when underlying business fundamentals don't justify optimism. This dynamic allows insiders to liquidate positions at artificially inflated prices, while retail investors accumulate shares based on unrealistic expectations. Professional investors often recognize narrative reality divergence earlier than retail participants because they focus on quantitative metrics rather than qualitative promotional messages. Institutional investors examine revenue growth rates, profit margins, return on investment calculations, and competitive dynamics rather than relying on executive presentations about future technological capabilities. Hedge fund analysis emphasizes cash flow generation over promotional narratives about future capabilities. Pension fund managers prioritize demonstrated profitability over speculative technology development. Private equity firms focus on sustainable business models rather than revolutionary transformation promises. However, momentum-driven markets can sustain narrative reality divergence for extended periods, allowing promotional narratives to support valuations despite fundamental weaknesses. This extended divergence period enables systematic insider selling while retail enthusiasm builds toward unsustainable levels. The eventual recognition of reality creates dramatic corrections that affect all investors, but insiders who sold early avoid the majority of losses. Regulatory frameworks provide limited protection against narrative reality divergence because securities laws focus on material misstatement rather than optimistic projections about future technological development. Executives can legally promote revolutionary capabilities that haven't been achieved as long as forward-looking statement disclaimers accompany promotional materials. This legal protection enables continued promotional activity even when private information suggests projected outcomes are unlikely. Media coverage patterns often amplify narrative reality divergence because technology transformation stories attract audience attention, while detailed financial analysis of development costs versus revenue potential receives less coverage. Business journalists frequently lack technical expertise necessary to evaluate promotional claims about artificial intelligence capabilities, leading to coverage that repeats executive messaging without sufficient critical analysis. The artificial intelligence sector broadly exhibits characteristics that create vulnerability to narrative reality divergence because AI technology capabilities are difficult for non-technical observers to evaluate accurately. Companies can promote AI developments that sound revolutionary to general audiences, while actual capabilities remain far below promotional claims. This information asymmetry enables systematic misleading of investors who lack technical knowledge to assess AI promotional narratives critically. Academic research on artificial intelligence reveals significant limitations in current technology that contradict promotional narratives from companies seeking to capitalize on AI enthusiasm. Machine learning systems require massive computational resources and training data to achieve narrow competencies in specific applications, contrasting sharply with promotional messaging about general artificial intelligence that could revolutionize business operations broadly. Current AI systems cannot reason, understand context, or adapt to new situations the way promotional materials suggest. Energy requirements for training large language models exceed practical deployment thresholds for most commercial applications. Computational costs for AI inference make many promoted applications economically unviable at scale. The competitive landscape in artificial intelligence includes well-funded technology companies, including Google, Microsoft, Amazon, and numerous specialized AI firms that possess superior resources and technical talent relative to Meta's AI initiatives. Meta's social media background doesn't provide competitive advantages in AI development, suggesting that the company's AI investments face disadvantages relative to competitors with more relevant technical expertise and resources. Energy consumption requirements for advanced AI systems create cost structures that may prevent profitable deployment at scale for many applications that companies promote publicly. Training large language models requires electricity costs that can reach millions of dollars, while inference costs for serving AI applications to users create ongoing expenses that may exceed revenue potential for many proposed AI applications. The current market environment creates additional risks for companies promoting AI transformation narratives because elevated valuations assume successful execution of technological developments that remain uncertain. If AI initiatives fail to generate projected revenues or require substantially higher development costs than anticipated, current stock prices could decline dramatically as investors reassess growth prospects and profitability expectations. Zuckerberg's continued stock sales during maximum AI promotional activity suggest recognition that current valuations may not be sustainable when AI development results become apparent. His revealed preferences through personal financial decisions contradict the optimistic public messaging about AI transformation potential, creating the classic narrative reality divergence pattern observed before major corporate corrections. This analysis examines observable patterns of executive behavior relative to promotional messaging rather than predicting specific stock price movements or providing investment advice. Understanding narrative reality divergence provides context for evaluating corporate promotional activities while recognizing that markets can sustain unrealistic valuations longer than fundamental analysis would suggest. The pattern identification remains relevant regardless of specific timing or magnitude of eventual corrections when reality recognition occurs.